Uh, Good afternoon, everyone. Hope the other two sessions related to indirect taxes, customs, FTP, GST have been very useful to all of you. Uh, Now we are going to cover the budget changes which have come up in the direct taxes, primarily Income Tax Act, as we do not have any wealth tax nowadays. So I'm just I'm just moving on the slide. We are going to pretty much talk about the changes which have come up in PGBP, taxation related to partnership firms, individual taxation, some of the quasi-judiciary setups which have been changed, along with the provisions related to return filing and TDS. Some of the other changes we'll cover later, including the Companies Act changes which have come up, wherein MC has even notified certain circulars yesterday and day before yesterday. To begin with, if I say one of the most important change or rather not a change which has happened, is that there is no change in the income tax slab rates for any person. Neither for individual nor for companies, AOP, BUI, partnership funds, HUF, like all the tax structure which has been settled or which has been framed in the last year budget and hence approved in Finance Act 2020 was kept intact. This means that the tax structure remains same. The surcharge, education cess, MAT rate, separate tax rates for companies, 115 BAB, BAC, BA, everything remains same. Let's move on to the actual changes which have come up. The first one, which is one of the most important change, which is here, is in respect of the depreciation allowance which can be taken on goodwill. So far, what used to happen is in case of purchase or merger and acquisitions, the goodwill is paid, and thereafter the entity can actually take the depreciation allowance on the goodwill which has been paid at the time of acquisition. Now, the definition of block of asset has, goodwill of business or profession has been excluded from that definition explicitly. That change has been made in Section 2. Along with it, the governing provision for depreciation, which is Section 32, there also the term goodwill of business or profession has been removed. The overall impact of this is that whenever goodwill is there in the books of accounts, it will not be depreciated as such in the tax books. In your accounting books, you can still take amortization or revaluation of goodwill as such, but there is no deductibility in your tax books of accounts. Rather, what will happen is this goodwill will be taxed as capital gains at the time of selling of the business at a later stage. Therefore, the purchase price of the goodwill will be the cost of acquisition for the calculation of capital gain. Since this provision has been inserted with effect from 1st April 2021, this is going to be a change in terms of your block of asset as well, wherein both the gross block and the accumulated depreciation shall be removed from the block of asset. There should be a few more details which will come up in terms of how that will happen. Certainly, this is eventually overturn of the decision of Honorable Supreme Court in Smith Securities Limited, where it has been concluded that goodwill should be forming part of the assets, and depreciation allowance should have been provided on the goodwill as such. Moving to the next item, equalization levy was inserted a few years ago, wherein the term equalization levy 2.0 was framed last year, when 2% tax has been levied on non-resident e-commerce operators. This time, certain of anomalies which have happened in equalization levy have been fixed. This is the reason why these amendments have been made retrospective from 1st April 2020, when EL 2.0 was introduced. These changes are the first one is the royalty and the fee for technical services. So it is explicitly provided that the royalty and the fee for technical services shall not be covered under equalization levy. It would mean that tax at 10% will be charged on royalty and FTS as per applicable DTA. Relief will also be provided. The next one is expanded scope of the considerations which e-commerce operator is supposed to cover. So over past year, we have seen different interpretation of consideration which have been explained by different e-commerce operators. Some of the e-commerce operators have been only charging tax on their portion of service. Now that consideration scope has been extended to include even if an e-commerce operator is owning the goods or not, even then equalization levy will be charged. And in a similar fashion, in the case of services, even if the services are provided by e-commerce operator or not, the equalization levy will be charged. For this purpose, the definition of consideration has been extended as well, which include 5 items in it, which pretty much is running from the Contract Act, wherein the acceptance of offer for sale is included. Placing the purchase order is also included. Acceptance of purchase order is included as the expanded scope of consideration. Payment for consideration is included, and supply of goods and services or provision for services, whether it is partly or wholly. So this would mean that equalization levy will be charged on the entire amount which is collected by the non-resident e-commerce operator. The third change which has been, or the third clarification which has been brought in place is in relation to is in relation to TDS. So there has been an anomaly wherein wherein the non-resident e-commerce operators were supposed to look forward for either the double taxation benefit or equalization levy. So that anomaly has been removed, and TDS will not be charged as such separately on this, only EL will be charged. And all these changes have been brought retrospectively from 1st April 2020. Moving on to the next item, which is MAT provisions for non-resident, for foreign companies. So what used to happen so far is a foreign company, while calculating its MAT income, can take the benefit of capital gains on transfer of securities, interest, royalty, and FTS while calculating book profit for the purpose of Section 115JB. Now, when dividend income has been taxed in the hands of companies or in the hands of assessees, the same calculation should apply on dividend income as well, and therefore a provision has been inserted where it is clarified that dividend income which is credited to the company's P&L shall be reduced from the book profit for the calculation of MAT, and in a similar fashion the related expenditure shall be debited to the company's P&L. This is one. The second one relates to the past year incomes. So it happens several times that income of the past years have been included in the current year because of either APA or because of secondary transfer pricing adjustments. Now, in both these cases, ideally, these incomes should have formed part of the previous years where these income would have been generated, and therefore now the assessee has an option to file an application to the assessing officer for recomputation of its book profits of previous 4 years. The limit of 4 years is actually being governed under Section 154, wherein the application can be filed, wherein the 4-year limitation period will apply from the end of the year in which the application is received by the assessing officer. So this is a very important change, because otherwise the dividend income would have been taxed, would have not been included in the computation of company's MAT for a foreign company. The next one relates to relief which is provided to the buyers and sellers of residential units. There was a press release last year on 12th of November, wherein government specified and extended the limit of Section 43CA wherein safe harbor limit has been provided from 10 to 20%. So if I take a step back, in the last year budget in Finance Act 2020, there was a provision of extending the safe harbor limit from 5% to 10%. This means that any residential unit which is sold lower than its circle rate value, that in that case the property owner, which is the construction company which has built up the project, shall not be charged additional tax on the difference between the selling price and the circle rate. Now, before Finance Act 2020, that gap was available at 5%. In the last year budget, it was increased to 10%. The idea was to ensure that several of the operators who have a large unsold inventory with them, they are able to sell the inventory even when the circle rates have been increased over time, while the prices which have been agreed with the sellers have not. So now that limit has been increased from 10% to 20%. As I said earlier, a press release was was issued earlier in November 2020 for this purpose, and now the change has been incorporated in the Act as well. Note that this applies only for the transactions which happened till 30th June 2021, so 5 more months to go. And this is only for the first time allotment of residential units, wherein the sale consideration does not exceed 2 crores. When the sale consideration exceeds 2 crores, then the limit will fall back to 10% for the current year, as was approved in the Finance Act of last year. Also, in a similar fashion, this benefit has been passed on to the buyer of the residential unit under Section 56(2), and therefore that will not be treated as his income separately. The difference between the circle rate and the actual price will not be treated as his income under Section 56(2)(10). So Section 44AA provides for the tax limit, provides for the threshold for the audit of any business or profession. Now, last year in the Finance Act 2020, this limit used to be a turnover of 1 crore for a business. For profession, the limit was 50 lakhs. Last year in the Finance Act 2020, this limit was increased from 1 crore to 5 crores, provided 95% of the transactions are digital, which is that not more than 5% of the transactions happen in cash. This includes, the term transaction includes both sale and purchase. So both money receipt and money payment, all of them should be in digital form, which is, cash should be less than 5% of the total receipts or payments. Now, this limit has been increased to 10 crores this year. This would mean that several of the entities who were earlier getting their audits done, and for them the due date for filing of ITR was 31st of October, that will fall back on 31st of July. So a lot of work of chartered accountants, which they feel now that is reduced because of the reduction in because of the increase in these limits, thereby reduction in the number of clients who would do tax audit. But on the other hand, their income tax returns would then be filed till 31st of July. So that's another change which is coming up here. Moving on to the next one. This is an important one which was even spoken by our Honorable Finance Minister Nirmala Sitharaman during her speech. So employees' contribution, the preamble of this change is that employee contribution, which is deducted by employer, is akin to a trust which employer gets into, and therefore it is employer's responsibility to ensure that he deposit that contribution to PF or superannuation fund or ESI or any other fund by the due date Now, up till now, the due date was always linked with Section 43B, which is the date of filing of return. And therefore, what happens is a lot of employers actually deduct the employee's contribution and doesn't deposit it or deposit it late, maybe like till the date of filing of return, so that they still can take that benefit as a deduction. Now, and And this is on one side was related to employees contribution. Then on the other hand, there was employer contribution for which section 43 limit was always there. Even if even if the employer contribution was deducted and not deposited even till the time of filing of return, the benefit of deduction could have been claimed even after filing of return in the year in which the payment is made actually. So now, and there have been several case laws up to the level of Supreme Court wherein it was settled that the payment is being made by employer and therefore he should not be harassed or again charged by not allowing the deduction under section 43B otherwise. The background, it's important to give this background because now what has happened is that under section 36, where the employer gets the deduction of employees' contribution to PF superannuation fund or other funds, the time limit is shifted. There is the section 36 is dealing with section 43B here, which means that due date falls back to the original due dates which have been defined in the respective acts, either PF or ESI. So for PF, the due date is 15th of the next month. For ESI, it's 21st of the next month. Now, if the assessee employer does not deposit the employee contribution to the PF or superannuation fund or the ESI fund by the due dates as prescribed in those respective acts and not by the income tax return due date, then he will not be allowed a deduction under this section. Now, one thing which is very important here is, though this change has been brought in the act, we believe that this is very much litigative and basis the precedents which have been set up in CIT versus Vinay Cement Limited earlier by Honorable Supreme Court. We feel that this might again be struck down soon, but till that time, certainly this disallowance will not be provided. This allowance will not be provided to employers who deposit the contribution of their employees late as per the respective laws of PF and ESI. So the next one is regarding the presumptive income section 44 ADA. Now, this section was introduced 4 or 5 years ago, and the idea was to replicate what was there in section 44 AD for the professionals as well. Now, section 44 AD includes individual HUF firms and LLPs as well, while for some reason at the time of drafting 44 ADA, LLPs have been excluded. One of the reasons why LLP could have been excluded from section 44 ADA was there was a separate requirement of getting the audit done by LLPs in their LLP Act, wherein there was a limit wherein under section 34(4), the turnover, if the turnover exceeds 40 lakhs or if the contribution exceeds 25 lakh rupees, then LLP is required to get its audit done by a chartered accountant. Now, what has happened is it was always apparent that if LLP word is not included in section 44 ADA, they cannot take the benefit. However, now it is explicitly excluded from section 44A by including the words that it excludes LLPs. Now, one anomaly which still remains there in section 44 ADA is in relation to HUFs. HUFs have been included in section 44 AD, which is to say that they can perform or they can do businesses. So they can do business operations. However, as HUFs cannot do a professional service, that is actually done by a person and not by HUF. Ideally, the word HUF should also have been removed from section 44 ADA. So we hope that this change may come up in near future. Otherwise, it's just a redundant language within the section 44 ADA. The next one is related to slump sale. Under the slump sale, what used to happen so far is only a transaction wherein a transfer of undertaking happens by way of sale qualifies as a slump sale. While now the definition has been expanded, wherein not just by the way of sale, but by any other means, if a transfer happens, that will qualify as slump sale. Now, when this transaction will qualify as a slump sale, it will be taxed under section 50B on capital gains. Now, this section is effective from 1st April 2021, which is for assessment year 21-22. It is important to note that again, this section has been introduced, which will pretty much overturn the ruling of Bombay High Court in Bharat Bijli Limited, wherein the taxability of slump exchange was denied in the absence of monetary consideration. Now that will not be denied, like it will be taxed under section 242 and section read with section 50B. So for startups last year, Section 80 AI, Section 80 IAC extended the scope of coverage by one more year. This year also the coverage or the scope of this section has been extended by one more year. So earlier, if the startup was incorporated from 1st April 2016 to 31st March 2020, that was that was the period which got extended to March 2021 and now to March 2022. In a similar fashion, Section 54GB, which provides exemption on capital gains when the proceeds from transfer of residential properties invested in the equity of any startup company, that has also been extended by one more year to 31st March 2022. Moving on to the taxation of partnership firm, there is one very important change which has come in section 45(4) and 4A. The earlier section 45(4) has been removed and a new section is introduced. Now what happens is when a partner retires or resigns from a partnership firm, he is being given a share either in the form of cash or in kind. And now that cash or in kind payment will actually be taxed to the firm. What will happen is that under section 45(4), in case of transfer in case of transfer of capital asset, this should be capital asset here. In case of transfer of capital assets, fair market value of the capital asset shall be calculated, and that will be the full value of consideration under section 48. And for money or any other asset, the value of money or the fair value of the other asset shall be calculated. Now, it is still open as to how the value of other assets or the capital asset shall be calculated. So we believe that government is going to bring certain valuation rules for this purpose. Along with this, one important change is that if there is any balance in the capital account of a partner which relates to revaluation of assets in the prior years, that revaluation or self-generated goodwill or any self-generated asset shall not be included in the partner's capital balance at the time of retirement, and that will be taxed separately in the hands of firm. So that's one major change which is coming up for partnership firms. We now quickly cover the changes which have happened in the individual taxation. The first one is, yes, it's a welcome move wherein the senior citizens who are above 75 years of age, they are not required to file their income tax return. It's a very narrow definition which is given, wherein if they have interest income, if they have only one bank account, or if they have only one banking relationship with only one bank in which their pension comes in, any interest which they earn from that bank also, in that case, bank is being given power to calculate the complete tax which applies on that individual basis the declaration which he will make, and then they will deduct the TDS accordingly. Apparently, this is going to be a bit trouble for the senior citizens, because so far now they have not been required to pay advance tax. Rather, they actually pay tax at the time of filing return, while now their tax will be deducted as TDS only at the time of receiving of such income. So though they have been given benefit of non-filing of income tax return, but on the other hand, it's a very narrow definition which only covers interest income and pension income. There are several senior citizens who have other income as well, including rental income or any shares income as such, which is not covered here. So probably it will apply only to very limited number of senior citizens. Dividend income, advance tax on dividend income. So this has been, so last year dividend income has been taxed in the hands of in the hands of receiver of dividend as against a DDT being charged by the company. Along with that, there is a anomaly which comes in from advanced tax perspective, wherein if advanced tax due dates have fall before the dividend is declared, then the taxpayer is not aware as to how they can actually pay tax at on the advanced tax due dates. Now that anomaly has been fixed, wherein it has been mentioned that they need to ensure that they are meeting all the subsequent advanced tax dates. Note that this is not applicable to deemed dividend under Section 222. It actually applies to the actual dividend which is received by the individuals. Moving on to the next one relating to LTC. This has been earlier introduced by our finance minister before in her press releases. LTC was always given on the actual expenditure. Now LTC can also be given in form of cash, wherein the specified expenditure is not more than 36,000 rupees, and it has been used for some of the expenditures on which GST is applied at the rate of 12% or more. Note that this only applies from 12th October to 31st of March 2021. For the next year, if this scheme is going to continue or not, we are not aware so far. ULIPs. So this is one major change which is coming up for HNIs, if I say. So far, the contribution to ULIP was exempt under Section 10DD. In the same manner, the redemptions from ULIP is also exempt. Now, from 1st February 2021, which is on the day when the budget was presented, this is effective in the sense that those NRIs who actually buy ULIPs wherein the annual premium is more than 2.5 lakh in a year, in that case, they will have to pay tax on the redemption when these ULIPs will be redeemed. So this actually applies only to all the new ULIPs which have been purchased after 1st February 2021. And in this case, it is also important that this applies on aggregate basis on all ULIPs. So if someone tries to buy 3 different ULIPs of 1 lakh rupee each premium, even then he will be covered in this case. Important to note that at the time of redemption, capital gain will be taxed at 10% without indexation benefits. Interest income on PF contribution. This is again just to ensure that that high net worth individuals who are getting employee contribution to PF, which is more than 2.5 lakhs, they are taxed on accrual basis. There is no tax at the time of withdrawal, as was the case in ULIPs. But here, the interest income on the employee's contribution will be taxed at the regular tax rate applicable to that SSC on accrual basis. So this is only applicable from contributions which are made after 1st April 2021. So you still have time to invest as much as you want in provident funds till 31st March 2021. There is no limit which applies till 31st March 2021. Relief to NRIs. So this is one very interesting change which has happened for NRIs. Now, what happens is if there is an Indian citizen who, if there is an Indian resident who goes abroad for work and retires in the same country and has a retirement benefit account as well in that notified country, wherein he was a non-resident in India at that time. Now, if he wants to come back to India, as of now, there are tax implications of repatriation of that overseas retirement account back to India. Government is introducing certain provisions wherein this might not be taxed on accrual basis, but on receipt basis. More details will follow from here. Moving on to the changes which have come up in relation to the quasi-judiciary setup. Faceless assessment, assessment was always there since a few years. Faceless penalty has been introduced. Faceless appeals have been introduced last year as well. Now faceless ITAT has also been introduced. Detailed guidelines will follow. So authority for advance ruling has been dissolved as the post of the vice chairman, the chairman has been vacant for a few years now, as that has to be a retired judge of a high court. Since AR was not functional, that has been dissolved, and a new board of advanced ruling has been introduced. Interesting to note that the decisions of the board of advanced ruling will not be binding on neither be binding on applicant nor be binding on department. We believe that this is going to bring a lot of litigations, as the aggrieved party may move to high court, be it the SSC or the department, so that is going to make a lot of cases up to the high court level as soon as the decisions of the board of advanced rulings will come out. So this board of advanced ruling will take effect from 1st of April 2021. Income Tax Settlement Commission has been dissolved. Again, there are, this has been on hold for for a few months, rather a few years now. And after the dissolution of Income Tax Settlement Commission, all the pending cases, the applicants have been given an option to withdraw their applications either within 3 months if they want to do so, or then their pending applications will be allotted to an interim board. This interim board will consist of a 3-member bench, which will be nominated by CBDT, and the central government have been given power to provide the guidelines, the exceptions, modifications, and which they can make from 1st of April, from 1st of February 2021. Note that the power is given to central government only for the next 2 years, which is till 31st March 2023. Dispute Resolution Committee, instead of IT Settlement Commission, a Dispute Resolution Committee has been set up under Section 245MA, which is primarily for small taxpayers, wherein the returned income is less than 50 lakhs and the amount of tax or variation in the tax is 10 lakhs or less. So this committee has power to reduce or waive off any penalty which is imposable under Income Tax Act. So probably this is going to be a big change for small and medium taxpayers if they want to go off from the legal proceeding and take the benefit of DRP. Income escaping assessment has been revamped completely, if I say this way. Now there was an earlier requirement. So there was an earlier process wherein the assessing officer can open the assessment for previous 6 years. That has been reduced to 3 years, only in case of severe information which they have in relation to the income escaping of assessee, which is more than 50 lakh in any particular year. The assessing officer can go back to 10 years and even in that case, he can go only to that particular year in which the income escaped is more than 50 lakh. If out of the remaining 7 years, there are only 2 years where the income escaped is more than 50 lakhs, only those 2 years assessment will be opened along with the 3 years, which he has a right to open within Section 148. Also, in order to initiate proceedings under Section 148, there is a whole list of steps which have been identified for the assessing officer, wherein he can issue notice only if he has information which suggests that income has escaped. And this information, now CBDT has a good foolproof risk management strategy formulation through AI and all the information which they have over past years. So basis that only the assessment can be opened or the notice can be issued to the officer, to the assessee. Important to note that even for sending the notice, prior approval of PCIT or CIT level officer is required to be taken. Only in specific cases, inquiry and opportunity of being heard is being given before the issuance of notice, which will not apply for search or requisition cases. Especially for opening proceedings beyond 3 years for up to 10 years, the approval of principal CCIT is required. Changes in income tax returns. The due dates have not changed as such. However, some minor changes or some minor realignments have been made, wherein the spouse of a partner who was earlier liable to audit and as per Income Tax Act, the income tax return of the spouse also is being extended to 31st of October. In a similar fashion, if there is a partner whose firm is liable to audit under 92E, their income tax return date is extended to 30th November now instead of 31st of October. Also, one very important change which is coming up is all the assessment proceedings relating to Section 139, 143, 145, 144, 146, 147, all of them, including 153, all of them have been reduced by 3 months. So there are several provisions wherein the time frame was up to the end of the assessment year in which the return is filed, which is being reduced back now to the end of the financial year for which the return applies, plus 9 months as such. So this is one change which CBDT believes that is because they are more capable to handle the returns. However, I feel that with this, their time is not reduced. Rather, it is the assessee's times of filing the revised return or belated return which is actually reduced, because maybe CBDT might have all the AIs but not the assessee. Section 139(9), again, defective return. Assessee will be intimated and 15 days time is being provided. Now, CBDT has powers to waive off some of these conditions where a return is defined as defective return. So expect that there will be lesser defective returns which will come up in near future. Reduction in time periods, again, intimation for section 43(1) is reduced to 9 months from the end of financial year. In a similar fashion, under section 153, completion of assessment proceeding is also reduced to 9 months from the end of assessment year. Again, I'm reiterating that pretty much the assessment by department is they have pretty much a similar time, because one, they have already been using AI, and second, when the time of filing return or belated return is reduced, they have their own 6 months in their hands to process the returns. So this is effective from 1st of April 2021. Another important thing is if this is effective from 1st of 2021, coupled with the income escaping assessment under section 147, that is going to have an impact on the demonetization which has happened in November 2017, because now what will happen is, from that date, the 3-year period would have already expired by 31st of March 2021. So we expect that department is going to finish sending all the notices by the end of 31st March 2021. These are the deductions which we have already covered before. One very important penal provision which is coming up now under section 281 is giving power of attachment of property in case the aggregate amount of penalty is more than 2 crores. So this penalty apply even if there is a false entry or omission of entry under section 271 AAD. So this is going to have a really big impact on the client and their consultants and their senior management of any company. Moving on to TDS provisions. TDS is like there are 2 major changes in TDS. I'm not going to cover these 2, but the major changes in TDS which have come up is introduction of section 194Q, which is a reciprocal section of section 206C1H. One of the important thing is that since this is TDS, this actually applies to buyer and not the seller, and therefore the 10 crore limit which was there for seller in TCS section will apply to buyer in TDS section here. Similar provisions have been made that if any other provision of TDS or TCS is applicable, then this section will not apply, barring section 206C1H, which was introduced last year. So now it is important to note that if both these sections are applicable, then 194Q will apply and not 206C1H. The next one relates to, we have seen 206AA introduced a few years ago, wherein a higher TDS rate of 20% was introduced if the PAN is not provided. We have seen instances wherein the TDS is deducted, PAN is not provided, higher TDS is deducted, and still individual does not file their income tax return and forego the TDS which has been already deducted for them. Now there is another penal provision which is inserted, wherein a higher TDS rate of either twice of the specified rate or 5% will be deducted if the specified person has not filed their income tax return in prior 2 years. The same applies for TDS and TCS both. We believe that CBDT is going to provide a utility to identify who is the specified person who has not filed his income tax return in prior 2 years. This is not going to apply on non-resident who does not have PE in India, and therefore they are not really required to file their income tax return in India as such. Companies Act, three important changes have come up. The definition of a small company has been redefined, has been expanded, wherein paid up capital increased from 50 lakhs to 2 crore, turnover increased from 2 crore to 20 crores. OPC by a non-resident, wherein OPC by a person who is Indian citizen is been reduced to 120 days, then 182 days. Even NRIs are also allowed to create it. MCA is going to have a new version 3.0. Several other decriminalization provisions have been inserted the way they have been inserted in Companies Act before. Moving on to some of the other provisions, corpus of, there have been significant changes in the corpus of in the taxation of corpus which has been received in charitable trust. We are really not moving on. We are just moving on from here in the interest of time. Disinvestments have been like demerger for banking sector units have been made, so that is going to have a big impact on sick banks which can still demerge and not are covered under capital gains. Cooperative banks have been restructuring have been done so that the cooperative banks can actually merge and or form a banking company. No capital gains will be applied on them. Several changes have been made in units in IFSC, including offshore banking unit and aircraft leasing. So these are the changes which have come up in the Union Budget 2021. Now the process remains the same, that these changes will be passed in the Parliament, and then thereafter they will be assented by the President of India, and only then they will be applicable, other than the ones which are